exchange markets pose a significant risk to those businesses exposed to their volatile and often hard to predict price movements. Exposure to these markets can arise from a multitude of business activities, such as import or export activities, that leave companies faced with uncertain expenses and/or revenues, a company with offshore subsidiaries that needs to translate these activities back into the domestic currency for reporting into the group financial statements. Even an intercompany loan from an offshore parent company can expose the business to uncertainty and potentially result in higher than expected loan repayments due to unfavorable movements in the exchange rate. Hedging is a means to manage or eliminate these and other market risks from a business. So why hedge? For many companies, the answer to this question is often for the benefits of achieving certainty. Certainty in costs or revenues, depending where the risk lies. Certainty in the ability to budget and achieve required profit margins. And why is achieving certainty of so much value to a business? Well, perhaps it's easy to answer with some insights into the forex market's typical behavior. The rand is known to be one of the most volatile tradable currencies in the world, with an average historical volatility of roughly 17% as an annualized percentage, realized over the last 10 years. This volatility is a measure of the average amount the price has differed from the mean over time, the standard deviation. It is an indication of just how much our currency's price can move, either up or down. But what we also know about the rand and its movements is that it can easily move much more than this average level, with extreme fallouts often experienced over very short periods. This year alone, the rand started the year trading around 14.50 against the dollar, and less than 4 months later saw historically weak levels above 19 being realized. Although we have learned the rand's potential to weaken, and sometimes very quickly, the opportunities do exist for rand recoveries to take place. In June 2020, just 2 months after trading above 19 to the dollar, when many were calling for 20 to be the next level traded, pullbacks to 16.50 had been achieved. It is this potential volatility that brings with it significant uncertainty to a company exposed to these market prices. And given just how many factors drive these price movements, many of them exogenous to South Africa's economic fundamentals, it makes predicting the next move even that much more difficult. Take a look at the impact on this unhedged income statement, given an unfavorable forex market move. In this simplified example, the importer, whose cost of goods sold depends on the dollar-rand exchange rate, stands to lose 1% on their net profit margins if the rand weakens from 17.50 to 18. A move back to previous levels of 19 from 17.50 reduces their margins by half. Similarly, an exporter converting their sales proceeds from US dollar into rands can see a significant impact on their net earnings if the rand strengthens below 17 again. There are many hedging tools available for consideration for companies looking to protect against these risks, and many look to employ a combination of the following. A forward contract is an agreement between the customer and the bank to fix the rate upfront for settlement on the agreed future maturity date. This product gives the hedger certainty on their future revenues and/or expenses, and is also often successfully utilized to lock in favorable outcomes when opportunities present themselves. Vanilla options offer insurance-type solutions to the hedger. They allow for protection at specified rates while still offering the ability to participate in favorable market movements. Given their profile of 100% protection and 100% participation, they require a premium to be payable upfront. Option solutions can actually be structured in many different ways to match the hedger's specific desired outcomes. For example, A zero-cost collar is a simple option solution that many exporters favor, because for no premium upfront, it offers 100% protection at a specified level, called the floor. It allows for participation within a range up to a calculated cap level. For those businesses that operate in these markets on both the import and export side, CFC accounts offer a vehicle to maintain any natural hedges within their activities. Establishing which are the most relevant hedging tools to employ is not a one-size-fits-all solution. Each company should consider their own specific business objectives to guide them through this decision-making path. What can your business afford, and what can't it afford, given the current economic climate and market conditions? I hope you found this insightful, but now is the time to assess your understanding.